Business and technology. We have covered chapter 1 to 10. Let's move toward chapter 11. Chapter 11. In chapter 11, there are two topics. One is governance and other is social responsibility. Governance and social responsibilities. So let's discuss governance first. Governance means corporate governance. Corporate governance. What does that? Corporate governance means a system by which companies are directed and controlled. A system by which companies are directed and controlled. Corporate governance means system. System means rules, force, through which company can be directed and controlled. In corporate governance are different rules that if director follow, they can direct the company in a better way or they can control the company in better. They can manage the company in better way. Mean corporate governance is a direction for the company that management need to follow. For every listed company, it is compulsory they need to follow corporate governance. Mean they need to follow certain rules. Who define these rules? Stock exchange. What is stock exchange? What is stock exchange? A place where companies' shares can be bought and sold. It's an institution who allow the buying and selling of company shares. Whose company? Who are listed on the stock exchange. If company is listed on the stock exchange define some rule for the company. And those rules are called corporate governance. Those rules help the management how they can manage the company in best way. Mean these rules, these system direct the company, and through these rules, the stock exchange can control the company. And if companies following these rules, they are under control. If companies are not following these rules, they are not performing properly. So for every listed company, they have to comply with corporate governance codes. What is corporate governance? A system, rules, codes, policies by which companies are directed and controlled. Who define the system? Stock exchange. Why? To protect the investment of shareholders. Mean if company is following corporate governance rules and body also checking those rules, this will provide a confidence to the shareholder like their investment is secure, is protected in the company. They can make investment through a trust that company is governed under some rules. Their investment is secure. If company not following any rules, obviously shareholder will not make investment because they are having no confidence that their investment is secured, protected in the company. Not only shareholder, the purpose of corporate governance is to ensure interest of other stakeholder as well. There are some other stakeholders who are linked with the company. If companies are following corporate governance codes, these corporate governance codes will provide guidance to the company how company can make a decision in best interest of all stakeholders. And if company following corporate governance code, It also provide a confidence to other stakeholder, like a company is ensuring their interest. Mean they can also have a long-term relation, make long-term benefit from the company because company is governed under some rules defined by the stock exchange. So what is corporate governance code? A system by which companies are directed and controlled to protect the investment of shareholders and to ensure the interest of other stakeholders. Now we need to learn these corporate governance rules, mean codes, the system, mean what are the codes, what are the rules that company need to follow. We should be aware of this. So let's discuss corporate governance codes, rules. Before discussing corporate governance code, we must be aware of structure of the business. In a company, there is a chairman. Under chairman, there is a CEO, chief executive officer, also called managing director. Under managing director, there is a board of director. BOD stands for board of directors. In board of directors, there are two types of directors. One is called executive directors, mean EDs, and other are called non-executive directors, mean NEDs. Who are executive directors and who are non-executive directors? Executive directors who have power to board and executive directors are full-time employee of the company. Involved in day-to-day. Full-time employee of the company and involved in day-to-day running of a business. While non-executive directors are part-timers. They are not full-timer. And they are involved in a strategy making of the business. Decision making of the business. They are not involved in day-to-day running of the business. They are not full-time. That's why they are not employed. Executive directors are full-time. They will be called employee. Non-executive director are part-timer. Part-timer mean they are serving the company on hourly basis. And against their hours, they will receive hourly fixed rate. They are not allowed to receive a salary because salary word is associated with a full-timer. They are not allowed for any kind of bonus. They are just receiving hourly pay. And they are involved in strategy making, decision making of time. In fact, these non-executive directors are experienced people who have worked in the industry as executive director before. Now they are sharing their experience, their knowledge in strategy making, decision making of the company. So that company can make best decision, expert decision. So executive directors are full-time employee. They are involved in day-to-day running of the business. And in their salary, along with the fixed salary, there is having a performance related element. What is performance related element? That is called bonus. How they can receive bonus? Based on achieving some targets. Like if company profit will increase by this percentage, you will receive this much of your salary as bonus. If company sale will increase by this percentage, you will get this bonus. And to get that bonus, they need to meet that target. And sometime if company is not meeting that target for the current year, they involve themselves in short-termism self-interest strategies. While for the company, short-termism strategies are not beneficial for the company. Strategies should be long-term. Because in short term, if you have made profit, over the long term might be you will not survive properly. You have to think about long-term survival of the company rather than short-term. But their bonuses are based on short-term results. So they sometimes prefer short-termism self-interest strategies to get their bonus. While non-executive directors are receiving just fixed hourly rate, there is no bonus element in their pay. There is no personal interest. So they challenge executive directive short-termism strategies. Mean they prefer company should prepare long-term strategies. So I'm differentiating both of these again. Executive directors are full-time employee of the company. They are involved in day-to-day running of the operations, and their remuneration include performance related pay like bonus as well. And to get that bonus, they sometimes involve themselves in short-termism self-interest strategies. Mean they consider best of themselves rather than best for the company. Non-executive director are part-timer. They are involved in strategy making, decision making of the company, and they received a fixed rate hourly pay. There is no bonus element, and they challenge short-termism self-interest strategies of the executive directors, and they share their knowledge, experience in best for the company strategies. So these are the people who are involved in the company. Now we are moving towards learning what are corporate governance codes that company need to follow. According to corporate governance codes, the first code says these non-executive directors should be independent. Non-executive director should be independent. What does that mean? Without their fixed rate, they shouldn't have any other interest with the company. They shouldn't have bonus element. They shouldn't have any other interest with the company. Otherwise, they will not make decision best for the company. They will also involve in self-interest strategies. So that's why they should be independent. Mean their work should not be influenced by any personal interest. They should not be shareholder of the company. They shouldn't be shareholder of the company. If they are shareholder of the company, they will consider best of our shareholder rather than best of our company. Isn't that shareholder best is best for the company?
No.
Why? How? Shareholder are the owner of the company.
But if we think the best of the company and more profit, then obviously the shareholder have the more.
No, non-executive director have to consider best for the company rather than best for the shareholder. Isn't that best for the shareholder, best for the company are same? No. Suppose company have made 100,000 profit for the year. What shareholder want? All the profit should go into their pocket as a dividend.
Yes.
But company need to keep some part of the profit as a reserve with company account to face uncertain future events. So if non-executive director are the shareholder, they will consider best for the shareholder. We pay all profit as a dividend. They will not prefer reserve policy. If they are not shareholder, obviously they will consider best for the company first, then for the shareholder. Non-executive directors should not be having any close relation with executive directors, either family or friendly. Because if they are having any close friendly or family relation with executive directors, they will not be challenging their short-termism self-interest strategies. They will prefer them. Non-executive directors should not be employee of the company. They are employee of the company. Either they are working under the executive directors or with executive directors, so they will not be able to challenge their decision. Not only current, even in last 5 years, they shouldn't be employee in the company. If they were employee in the company, even in last 5 years, they will not be considered independent. Non-executive directors should not having any trading relation with the company. Trading relation means they shouldn't be the customer or supplier of this company. Otherwise, their independence can be compromised. The non-executive directors should be independent. Mean they shouldn't have any other interest in the company. They shouldn't be shareholder. They should not be having close relation with executive directors. They should not be employee, not even current, even in last 5 years. And they shouldn't be having any trading relation with the company, not only current, even in last 3 years, there shouldn't be any trading relation. Otherwise, they will not be independent. They will not be considering best for the company. Second quote. According to corporate governance codes, board should be balanced. Balance means there should at least half of the directors in the board should be independent non-executive directors. Board should be balanced. If there are 10 directors, how many should be non-executive? 10. If there are total 10 directors, how many should be non-executive? 5. If there are 7, how many should be non-executive? 4. At least half. Shouldn't be below half. More is better. More is better. Why? If executives are in more, then how board may decide a final decision? There are different options that they choose one option through raise of hand by the directors. If executives are more in number, then non-executive will not be able to challenge their short-termism option strategies. If non-executives are in more, they can challenge their short-termism strategies easily and can avoid them. If executives are more, they can impose their decision because their hands are more, their votes are more. So that's why there should be at least a half non-executive directors.
The financial director will come in the board of the company.
All directors come under board of directors, either finance director, executive directors. So third rule, according to corporate governance code, this chairman and CEO should be separate person. No one individual should be having both the position of chairman and CEO. If there is one person having both position, his dominance will be high in the company. Nobody will be able to challenge his decision. He will run the company in his personal interest. So that's why chairman and CEO should be separate. And for chairman, he should be independent non-executive director. Mean leader of non-executive director. While CEO, the name suggests to chief executive officer. He is normally leader of executive director. Even their role are different. Chairman role is to run the board, while CEO role is to run the company. Means CEO is the leader of the company regarding company transaction, regarding company performance. He is leading the executive directors in day-to-day running of the operation. He is the main person who is dealing with the bankers, who is dealing with the suppliers, who is dealing with the customers.
All executive things happening.
He is responsible for performance of the company. While chairman role is internal. Internal mean he will make sure whether executive, non-executive are making strategies properly. They are holding regular meetings where they are discussing issues and then deciding those issues. They are having no clashes. Non-executive are properly challenge their strategies. So he will look for the internal matters while CEO is mainly focused on external stakeholder. Even their role are different. That's why they should be of two separate person. One person should not be holding two positions. So non-executive director should be independent. There should at least half non-executive directors and chairman and CEO should be separate person. Okay, now moving further. According to corporate governance code, there should be four type of committees in the company. Mean these board of directors should perform their role by sitting in the committees. Mean there should be four board committees in the company. Board committees. What are those board committees? There should be nomination committee. There should be remuneration committee. There should be audit committee. And there should be risk committee. According to corporate governance course, in a company, there should be four type of board committees. Who should be the member of these committees? The members of nomination committee and risk committee could be both executive and non-executive, but majority of the members should be non-executive directors. If committee is having five members, how many should be non-executive? Three. If they are having six members, how many should be non-executive? Three. Four. Majority, not equal. Majority mean more than executive directors. Should not be equal. In a company, it could be equal, but in a committee, while for remuneration and audit committee, all members should be 100% independent, non-executive directors. Executive directors cannot be member of a remuneration and audit committee. Why? We'll discuss later on. So according to corporate governance code, there should be four type of board committees: nomination committee, remuneration committee, audit committee, and risk committee. The member of nomination and risk committee could be both executive, non-executive, but majority should be non-executive directors. While the member of remuneration and audit committee should all be non-executive directors. The executive directors should not be part of remuneration and audit committee. Now discuss what are their roles and why their members should be like this. The role of nomination committee is regarding the appointment, reappointment, removal of non of board members or directors. Who appoint the directors? Shareholder. Who remove the directors? Shareholder. Who reappoint the directors? Shareholder. Like every 3 years, directors should be reappointed. Company will see if they are performing, they will be reappointed. If they are not performing, they will be kicked off easily. But shareholders are not inside the company. Who help the shareholder regarding appointment, removal, reappointment of directors? Nomination committee. If during the year any directors resigned or died, who will fill his vacancy, his position? Nomination committee. They will advertise the vacancy, they will receive the CV, they will shortlist the candidate, they will make the interview and finalize the direction. His members should not be majority executive directors, otherwise they will appoint yes men to strengthen their position. To make independent appointment, the majority member should be non-executive directors. What is the role of remuneration committee? The role of remuneration committee is to define remuneration policy of the company. Mean who will get what level of employee will receive how much basic salary, how much pension, how much other facilities, who will get helicopter, who will get jet, who will get airplane, who will get a car, who will decide? independent non-executive directors remuneration committee. Mean the people whose pay is going to be decided, they should not involve in setting their own remuneration. That's why their members should be non-executive director, not executive directors. Because non-executive director are just working on hourly rate, and that rate is according to industry average, and there is no debate on it. Who is getting other facilities? Mainly executive directors. So they should not be part of setting their own remuneration policy. So remuneration committee is role is to define independent remuneration policy of the company. While audit committee role is to oversee financial matters of the company. Is to oversee financial matters of the company. They need to review financial statement of the company, whether financial statements are produced true and fair or not. They need to review internal control system of the business. What is meant by internal control system? Rules, regulation system of the business, either IT system or manual. They need to review whether it is working properly or not. They need to review financial strategies or financial policies of the business. Strategies are long term while policies are short term. Who prepare these financial strategies, financial policies? Finance director. And finance director is the executive director, who will review whether his policies, strategies are in best for the company or not. Independent non-executive directors audit committee. That's why their members shouldn't be executive directors. Otherwise, they will be reviewing their own policies. Audit committee role is to monitor what? Quality of work and independence of both internal auditor and external auditor. Who is external auditor? Who comes from an audit firm, who check the financial statements of the company and express our opinion, give a report on the financial statements, whether financial statements are true and fair or not. Audit committee will ensure he is performing his work properly or not, and he is performing his work independently without any threats on independence or not. Who is internal auditor? He is an employee of the company who is helping the company management where in implementing and reviewing internal control system. So audit committee will make sure whether he is performing his work properly or not and independently. Audit committee provide recommendation to shareholder regarding appointment. Here's what I found. Reappointment, removal, and fee of external auditor. Who appoint the external auditor? Shareholder. Why? Please check these financial statements prepared by my directors, whether they are true or not. Normally, companies reappoint previous external auditor again if they have performed better. If external auditor is not working properly, who can remove? Only shareholder. And if shareholder are appointing a external auditor, they will decide their fee. But shareholder, if they are sitting in any other country, so they are not aware about who is the good auditor in the country, how auditor is performing his work. So who is helping the shareholder regarding appointment, removal, reappointment of external auditor? Independent non-executive directors audit committee. So these are the role of audit committee, mainly relating to financial matters. And audit committee members should be financial expert. And at least one member should be recent financial graduate who have recent knowledge about the financial standards so that he can check compliance. There should be risk committee. The role of risk committee is to define a risk management strategy of the company. What is risk management strategy? To identify risk, to control risk, and to monitor risk. In what risk business is going to face in the future, company need to identify on proactive basis. Who will identify business risk? Risk committee. How to control the risk? How much company need to spend to control the risk? What policies company need to adopt to control the risk? Who will define those policies? Risk committee. And whether those policies for controlling risk are working properly or not, who will check, who will monitor? Risk committee. Their members should be majority non-executive director. Why? The risk business is going to face in day-to-day running of the operation should also be identified through executive directors. But to make independent risk management strategy, majority of the members should be non-executive directors. And these three committees, nomination, remuneration, audit, are compulsory. Risk committee is optional. If it's having, better. If it's not, then his role must be performed. Who will perform risk committee role? Audit committee. So according to corporate governance codes, non-executive director should be independent. There should at least half non-executive directors. Chairman, CEO should be separate person. And there should be 4 types of board committees: nomination committee regarding directors' appointment, reappointment, removal; remuneration committee to define independent remuneration policy of the company; audit committee to oversee financial matters of the company; and risk committee to define risk management strategy of the company. And who should be their member? We have discussed. So let's move towards reading. Separation of ownership and control. Company is a separate legal entity, artificial person in a society. Who are the owner of the company? Shareholder. Who is the management of the company? Who run the company? Board of directors, BOT. This separation can bring benefits for both parties. Specialist managers can run the company better than shareholder. Might be shareholder are not expert in managing the company. And manager cannot personally contribute all the capital needed. That's why the investors they require, and those investors are shareholders. So directors are agent of a principal shareholder. Who is a principal shareholder? Shareholders. And who is their agent? Directors. There is agency relationship between principal shareholder and agent director. Agent mean a person who is working on behalf of other against any reward. Directors are working on behalf of shareholder to manage their company against their pay, against any reward. This means this director agent have to make all the decision in best interest of the principal shareholder. But they do not do like that. They sometimes consider their own personal interest. This is called agency problem. How this agency problem can be resolved? by appointing non-executive director in the company and by appointing auditor who will check the financial results of the executive directors. What is corporate governance? Corporate governance is the set of process and policies by which a company is directed, administered, and controlled. It includes the appropriate role of board of directors and of the auditors of the company. The main recommendation of best practice in effective corporate governance code include the membership of the board of directors, both executive and non-executive should be there. Directors' remuneration is decided by remuneration committee and should be disclosed, means should be independent. The role of both internal and external auditors should be monitored by audit committee. And how the public is a legitimate stakeholder in a company, mean company need to focus not only best of shareholder, best of other stakeholder as well. Who are non-executive directors? Those who are involved in the day-to-day running of the company as executive directors. NEDs are not employee of the company and have no managerial responsibility, mean not full-time employee, meaning they do not participate in day-to-day running of the organization. However, non-executive directors do attend board meetings and therefore have a say in strategic decision. Mean they can challenge short-termism strategies. Non-executive directors have several key roles. I mean, there are 4 types of role of non-executive directors. Strategic role, performance role, risk role, and people role. Strategic role, risk role, people role, and performance role. Strategic role mean they share their experience, their knowledge in making this best strategy for the company. This is their strategic role for which they have been brought to the company. Performance role is relating to audit committee. They review performance of the company, performance of the directors, performance of the auditors as well. Mean they oversee financial performance of the company. Risk role, they prepare risk management strategy like identify, control, and monitor business risk. And people role is nomination committee. They help the company in appointing, reappointing, and removing directors. Like if company is lacking any skilled director, who will appoint that skilled director? Nomination committee, that is called people role. And they define remuneration policy of different people in the organization. So this is their definition. This is audit committee, this is risk committee, this is nomination plus remuneration committee. And non-executive director should be independent. Mean they shouldn't have any other interest in the company except their fixed hourly pay. They shouldn't be having any trading relation, not only current, even in last 3 years. They should not be shareholder of the company. They should not having close time in close relation with executive directors. And they should not be in the company for more than 9 years. Otherwise, their independence will be affected. A non-executive director can be non-executive director in a company, maximum up to 9 years, not more than 9 years. Other recommendation, half of the directors should be independent non-executive directors. The non-executive director should be appointed to the senior independent director. Mean one of the non-executive directors should be called senior independent non-executive director. Normally, non-executive director are part-timer, but one member of non-executive director should be full-timer, who will be named as a senior independent director, who will always be available in the company for shareholder concern. And normally company chairman becomes senior independent non-executive director, mean full-timer. Executive director would typically be required to stand for re-election by every 3 years, mean executive director should be reappointed every 3 years by the shareholder. Mean they should be appointed with a contract of 3 years. Who says? Corporate governance codes. Now we are moving towards different committees. Remuneration committee responsible for setting remuneration policy of the company, and they should be made up of non-executive directors. What are the advantages of remuneration committee? It avoids the agency problem of director deciding their own level of remuneration, mean they will not be involved in setting their own pay. It leaves the board free to make strategic decision about the company's future. And disadvantages, entities might recommend a high remuneration for executive directors on the understanding that the executive will recommend a high remuneration for themselves if they are having close ties with each other. And there will be cost involved in preparing for and holding a committee meetings. Obviously, if non-executive director are charging on hourly rate while deciding remuneration policy, they will spend the time. So there will be cost for the company as well. Audit committee, whose role is to oversee financial matters of the company. What are his role responsibility? Reviewing accounting policies and financial statements as a whole, whether they are in best of the company or not. Reviewing system of internal control and risk management. Agreeing the work agenda for internal audit department, monitoring internal audit work. Making recommendation to the board to put to the shareholder relating to the appointment, removal of external auditor and his remuneration fee. Analyzing with external auditor, and he will monitor the quality of work and independence of external auditor as well. What are the advantages and disadvantages of audit committee? The main advantage of audit committee is that it allows auditor to report their findings to independent directors. I mean, if auditor is finding any issue, to whom he will communicate to audit committee to make his independence. But there are some problems. External auditor do not have to report frauds or errors to the executive directors who may be responsible for perpetrating them. I mean, if he is highlighting some fraud errors in the financial statements to the directors, so he is reporting to the people who have made those fraud. Internal auditors are likely to feel comfortable reporting system weakness to the executive directors who will have designed the system. So there could be some issues for external internal auditor as well. There should be nomination committee who will monitor the process of appointment of director to the board of director as well and making recommendation for reappointment to the shareholder. And his role are various skills needed to be person on the board. Nomination committee will see if there is any skill required for the business in director. They will identify those skills and appoint that skill director. Like IT skill director is not there, they will appoint that. They will see whether companies are having at least a half non-executive director or not. If non-executive are lesser, who will appoint new non-executive director? Nomination committee. Need for continuity to the board. Continuity mean future human needs. Mean if suppose in future one of the director is going to retire, who will appoint a new director or arrange a new director if he retires to fill his position? Nomination committee. And a need to attract directors from diverse background. Obviously, they will check their background, their performance, their qualification, experience, and then they will appoint a new director. What is a public oversight? In UK, there is a public oversight board. In UK, there is a public oversight board who need to ensure whether company is disclosing everything about them in annual reports or not. Every year, companies need to produce annual reports. Every listed company have to produce their annual reports. Are in annual reports, financial statements are in annual reports, all the components set, audit report. In annual reports, there is a chairman statement. There is chairman statement as well as a CEO statement. Means both of these persons have to provide their statement in the annual report where they will show from how long we are working with the company and what we have done in best for the company. In annual report, there should be all committees statements. In four committees will provide their statement who are our member, what is our role responsibility, and how we have performed our role responsibility during the year. In annual report, companies sometimes provide CSR reporting. CSR stands for corporate social responsibility reporting. Like if company have performed something for the society, like they have provided some donation, charities, they have done something for the society, they will make a report and publish in annual report. So for every listed company, annually they have to produce their annual reports for the shareholder. This oversight board will make sure that the company is providing all these disclosure in the annual reports or not. Because if company is not providing, they are not complying with the rules. So what is oversight board? The public is a legitimate stakeholder of large company. So company should provide information to the public, to all stakeholders. This means that the public has a right to know how such a company is being governed and as well as right to be involved in the governance process. The most obvious of public oversight of corporate governance is via the publication of their annual reports, in which financial statements, audit report, chairman CEO statement, committee statements are there. Such countries are in industries have set up public oversight board. These organizations monitor whether organizations are complying with relevant rules and regulations to take action against those that fail to meet the required standards. I mean, if companies are not providing disclosure required, they will take action against the company. What are the benefits of corporate governance? If company follow corporate governance codes, what could be the benefit? If company follow corporate governance codes, directors will be having a proper guidance how to manage the company in the best way. So company can make a high profit. This will help the company in making high performance. Corporate governance scores boost up the investor confidence, like their investment is protected in the business. It's secure because company is running through a system rules. By having corporate governance scores, company can minimize the wastage, company can avoid corruption, company can avoid risk. They can manage the company in best way. And if companies are following corporate governance codes, company can meet the listing requirements, mean they can maintain their listing on the stock exchange, their registration on the stock exchange, mean they can easily buy, sell their shares. So corporate governance topic is completed now. Now we are moving towards second topic of this chapter, that is CSR, corporate social responsibility. CSR stands for corporate social responsibility. What this concept say, company is a separate legal entity. Company is a separate legal entity, like artificial person in our society. Asset of the company are asset of the company rather than the owner. The liabilities of the company are liabilities of the company rather than the owner. So being an artificial person in a society, company have to behave like human being. They should not consider only their profit. They should consider best for society as well. Because from society, you are getting the profit. Because from society, you are having the employees, you are having the customer, you are having the investors. You should also consider best for society as well. Means sometime company have to forgone, leave his benefit for the society. Mean company have to bear some of the social cost. Mean for society, they have to provide charities, they have to provide donations, They have to create something physical like parks in the local community, roads in the local community, sports complex in the local community. I mean, they should look for benefit of the society as well. Because through this, company reputation will be increased, and through high repute, you will be attracting more customers and more investors as well. So CSR concept says company should not only consider his personal best, mean should not focus on profit, profit, profit. They should focus on social responsibilities. So CSR refers to the idea that a company should be sensitive to the need and wants of its stakeholder. Who are in the society? Stakeholders. Mean they should not consider best of shareholder only or themselves. They should consider best for all stakeholders who are stakeholder societies. So need and wants of its stakeholder rather than just the shareholder. It refers to an organization obligation to maximize its positive impact upon a stakeholder while minimizing the negative impact. I mean, if you are not focusing best, not providing any benefit, you should not affect negatively the society. CSR is closely linked to sustainable development. What does mean by sustainability? Sustainability means meeting the needs of present world without compromising the future as well as future generation. Meeting the need of present world without compromising the future and future generation. What does that mean? Company uses different resources, especially company use natural resources for their production. Like if you are a furniture company, you are using wood from the tree. If you are just using resources, one time will come, resources will be finished. You will not be having resources for the production, mean you will be compromising your future. Not only your future, you are also affecting the future generation as well because they will not be able to see those resources. So to become sustainable, mean long-term focus, you should reproduce, replenish, or renew the resources along with their usage. I mean, if you are building more trees and then you are cutting trees, taking wood for your furniture, so you will be sustainable because now you are not only using resources, you are also renewing, reproducing, or replenishing the resources as well. And if business is renewing, replenishing resources as well as using, this means they are meeting the need of present world without compromising the future as well as future generation. So being a sustainable business, not only we should focus on social responsibilities, we should focus on environmental responsibilities as well. So CSR is closely linked to sustainable development, which encourage organizations to use resources in a way that do not compromise the need of your future as well as future generation. To improve CSR, an organization must first understand who its stakeholder and why they expect what they expect. Meanwhile, making a decision, you have to focus on best for all stakeholders rather than your own best only. The importance of CSR will help to attract the customers because your repute will be good. Attract the potential employees. Employees will prefer to work under your organization because you consider best for all stakeholders. Obviously, before society, you will consider best for employee. Save the business money. Mean you don't need to make too much advertisement because your image is good in the market. Customer will automatically be attracted to your business and reduce the risk of the organization, and your organization will be risk free. Like in future, you will be having resources for your long term survival. But there are some drawbacks of CSR. Loss of business value can be management acting against their primary role of running high return for investor. Mean if you are not focusing on best for shareholder, best for society only, then investor will withdraw their investment. This can affect business. Mean you have to focus on both sides equal. Maximization of profit can be seen as socially responsible. And if you try to maximize profit to keep shareholder happy, this will affect society. Increase cost of raw material. We see you need to replenish as well. Have to turn away business, mean you need to grow business as well. And you need money. If you are spending too much on society, stop suddenly to focus on business activity. This will also affect your repute. And increase management time, and to focus on CSR, ultimately management needs some time as well. Mean they need to find area where we can make positive impact. So what are committees? Not corporate governance committee, board committee. There could be some general other committees in the business, not required by corporate governance. Committee, what is a committee? Committee is a group of people appointed to discuss or focus on a particular subject, like nomination to focus on appointment, reappointment of directors, remuneration committee to focus on defining remuneration policy, risk committee to focus on controlling business risk, audit committee to focus on overseeing financial matters. So committees are group of people appointed by the management to focus on a particular issue. Tend to be permanent. Committees could be permanent or temporary. Means suppose if there is any fraud happens in the company, and to investigate the reason causes of the fraud, who are people involved in the fraud, you have made a group of people called fraud investigation committee. After highlighting the perpetrators, mean fraudsters, and how fraud has happened, mean after finalizing their report, that committee will be finished, will be called temporary committee. But board committees are permanent. So could be long term or short term, and have authority regarding particular issue, and follow well established procedure, mean they have to follow procedures and provide a way of thinking difficult decision, mean they are some expert people who need to focus on some expert issues. What could be the purposes of committee? Committee can brainstorm new ideas for organization, mean they can help the organization in making some new ideas in innovation because they are expert people brought together. Allow a number of people with the different skills and the knowledge to work together in a coordinated manner, mean different skill people will work together in a committee. Act as delaying mechanism, not delaying, it's a relaying mechanism. Mean management can rely on their expertise, and they can help to make or implement a decision with the organization, and they help the organization in making important decisions. They can oversee function procedures like a nomination committee, appointment function, remuneration function, audit, financial matters, and risk committee, risk management function. And in business, there could be some general committees. Executive committee means committee of a board of directors who are involved in making a decision for the business. Standing committee, a committee that is to focus on a particular issue that is for particular purpose and permanent basis, like audit committee, risk committee, those are called standing committee. Ad hoc committee that is formed for temporarily against any emergency, like a fraud investigation committee. Because if you don't check the reason behind the fraud, who are involved in the fraud, then fraud will not be controlled. So you have to make a group of people committee to investigate that fraud. That will be called ad hoc emergency or temporary committee. And there could be subcommittees like committees sometime make their subcommittee if they are having too much responsibility. So they focus on main issues, and for smaller issues, they have made an other subcommittee that will be finding and reporting to the main committee. Ad hoc means temporary or emergency committee, like fraud investigation committee. After investigating the fraud, this committee will be finished. What could be the advantages of committees, general committees? Bring together individuals with the necessary skills and knowledge, tend to slow the decision making process down. Obviously, if committees are there, decision making will be slow. Decisions are more likely to be accepted by the organization because they are made by expert people. More people are involved in decision making process. Setting up committee can delay the decision make process, buying a company time because they need to decide on depth knowledge. And collective responsibility mean that no individual member of committee is likely to be held responsible. All will be equally responsible. But there are some disadvantages. Decision making can become slow because they need to investigate everything in more detail. Collective responsibility means that no individual is likely to be held accountable for poor performance. Mean there could be some members in the committee who are not performing. There could be some who are more performing, but they are collectively responsible. Members of committee may wish to further the objective of their own department. Mean if you have made different department people into fraud investigation committee, if they are focusing on fraud investigation, their main department function can be compromised, can be affected. Committees tend to work based on compromise between various members. There could be some conflict between members. And committee members normally only attend a committee part time. They are not focusing full time as a committee. And experienced committee members may dominate the others, mean they will not listen to others. Who is chairman? Non-executive director, whose role is internal. What are his roles? Keeping the meeting on schedule and agenda, mean A to see whether directors are making regular meetings or not. Maintaining order, mean there shouldn't be any conflict between executive, non-executive directors. Impartial, mean non-executive should be impartial. And summing up, mean through meetings, if there are any decision have been made, they try to sum up the decision and checking and signing the minutes of the meeting, and they will ensure whether the minutes of meeting, what is minutes of meeting? Records of a meeting discussion. In whatever is discussed with the meeting, they need to record so that if there is any absent member, they should be aware by reading these records what have been discussed and decided in the meeting. So chairman will make sure whether minutes of the meetings are properly recorded and provided to the absent members or not. Along with chairman, there is a person who helps the chairman, that is called secretary. And there are three types of role of the secretary. Before the meeting, he need to perform some role. During the meeting, he need to perform some roles. And after the meeting, he need to perform some role. Before meeting, secretary will fix the date, time of the meeting according to the availability of all the directors. He will book the venue where meeting should be placed, either within the company, in the company, which room, or which place, or outside the business, at what place. And he need to decide the agenda. Agenda mean purpose of the meeting. That they need to communicate to all board members along with invitation of the meeting, so that every member should be prepared for what matters we are going to the meeting. I mean, what is the purpose of the meeting? What matters we need to discuss in the meeting? What's the time period, at what time which issue will be discussed? So before meeting, He need to fix the date, time, set the venue and agenda. During meeting, he has to assist the chairman for note taking, make notes, and advise the chairman on point of procedures. Mean how he should start the meeting, first what he should discuss, after what he should discuss, and at the end what he should discuss. And after completing the meeting, he need to prepare the minutes and provide it to the absent members. The agenda should be before meeting, after meeting, during meetings. Agenda should be before, during, or after before meeting. Minutes of the meeting, after meeting. Making notes of the meeting. And after the meeting, he need to act on and communicate a decision. Mean whatever people have decided during the meeting, okay, we will do this, we will do this. He need to make sure, he need to remind those people, you have committed this, so do this, and deal with correspondence. Mean he will communicate with all the members, with the absent members as well. Chapter finish. Let's move towards MCQs. See whether MCQ 1 is a true or false. The separation of ownership and controls refer to the fact that owner of company are always different people of the director of company. Sometimes directors are also shareholder, not always. Some directors could be shareholder as well. Always different, not always. Which of the following can non-executive director accept as remuneration from the company?
A fixed daily rate for
A fixed daily rate for their time. Shares no, pension no, equity shares option again, shares no, A only. Equity is the name of shares. Number 3, which of the following benefit could be realized from a successful CSR program? Good luck, everybody. Benefit of CSR.
one, two, three.
Number 8.
Option A, 1, 2, 3.
Strategy assets such as license to operate. Improve in innovation by identifying new market opportunities. CSR, through CSR, you can improve innovation. No. Improvement in the company's reputation. Yes. Improvement in relation with internal and external stakeholder. Yes, because you are considering best for all. Maintenance of strategic assets such as license to operate. Means strategic assets, company brand name
Yeah.
can be maintained.
Yes.
Mean repute will be high, goodwill will be high. So select one of the following 2, 3, 4 where?
2, 3, 4.
P. Number 4. Good luck, everybody.
It's for fraud ad hoc committee. It's for fraud.
Why not Permanent or executive committee.
Permanent.
XPLC has appointed 5 members of staff to a new committee. The committee's purpose is to investigate a one-off failure in X production process that led to the loss of 100,000 worth of products and to make recommendation as to how X can avoid similar problem in the future. So they need to investigate one issue and its causes. So this is ad hoc. Standing, we haven't studied any stand. Executive, yes. Permanent, no. So this is ad hoc. Number 5.
Half. At least half.
At least half.
Yes.
C option. Number 6.
Speeding up the decision making process.
Gathering of information about a given issue, yes. Speed up, no, they will slow down.
They will slow.
Oversee of a function or procedure, yes. Coordinate with each other as well. Let's take a break. Break. We'll start next chapter. So moving towards next chapter, law and regulation governing account. In this paper is about basics of accounting profession. We are learning about business, different types of business, what are the structure of business, what is the culture, what kind of technology used in the business. We have discussed about governance. Relating to governance, there is another chapter called law and regulation governing accounting, mean who govern the accounting profession in businesses. There are different bodies who govern, who define different laws, different standards for the accounting profession, for the businesses that business need to follow. Every country is having a regulatory body who govern the accounting profession in the country. As we are studying ACCA, ACCA is based in UK. In UK, there is a body called Companies House who govern the accounting profession in the UK. They define different rules that accountants or every business have to follow in the accounting profession. So in most countries, there is a government department which has been set up to oversee the regulation and accounts of companies. In UK, this is known as Companies House, but it goes by various names in other countries such as Company Commission. In different companies, there could be different bodies, but in UK, there is Company House. Companies are usually required to submit their financial statements to these bodies. They will check whether you are preparing financial statements as per accounting standards or not, as per local laws or not, so that interested parties can inspect them. In addition, companies can also have to retain and submit certain key documents such as to the register of shareholder and register of directors. We not only company need to prepare financial statements, they have to maintain a shareholder register called member register and a director register as well. And they need to submit to the company house. They will make sure whether you are complying with laws or not. I mean, this chapter is totally about reading. Who is auditor? Mean external auditor. A person who will check financial statement and express opinion on financial statement. Opinion means he will provide report called audit report. Auditor provide two types of opinion. One where he will say financial statements give true and fair view. If financial statements are true, he will say financial statements give true and fair view. Other kind of opinion, he will say financial statements do not give true and fair view. If auditor is saying financial statements give true and fair view, this kind of opinion is called unqualified opinion. Unqualified opinion means opinion in favor of the company. Mean financial statements give true and fair view. If he is expressing opinion against the company, mean he is saying financial statements do not give true and fair view. This kind of opinion will be called qualified opinion. These two words has been used in later on part of this chapter. That's why we are discussing what is about unqualified opinion and what is meant by qualified opinion. Unqualified mean in favor of company, financial statements give true and fair view. While qualified mean against company, mean financial statements do not give true. I mean, after checking financial statements, what auditor do? They express opinion in the audit report. whether financial statements give trend fair view or do not give trend fair view. Either they express unqualified opinion or qualified opinion. Okay. There is another authority in every country, tax authority, who is checking whether companies are complying with the tax regulations or not. I mean, there are some threshold. If companies are reaching those threshold, they need to pay tax. Below that threshold, if their income is below that limit, they don't need to pay tax. But if their income is above that limit, they need to pay tax. Even the limit will be increased, the tax rate will be increasing. So companies as well as individuals are accountable to the tax authorities in the country in which they are based. They have to prepare tax return each year. Tax return mean detail of their tax amount, mean how much was their income and they are paying how much tax. That is called tax return, showing the amount of taxable profit they have earned in the period. For many countries, business will also have to submit return showing the amount of sales tax, value added tax that they owe to the tax authorities as well. Value added tax, sales tax means the product we are buying. In that product, we are also paying tax to the seller. So seller have to prepare tax return and pay tax to the tax authorities on behalf of us. Other authorities in UK, most business in the financial service industry handle client money, like banking sector. They have been regulated under a body called FCA, Financial Conduct Authority, or PRA, Prudential Regulation Authority. Banking sector are public bodies that monitor and control the effectiveness of organization within industry to protect the client against failure or poor advice. Charities are monitored in UK under the Charity Commission. The electricity company energy sector is monitored under OFGEM. Mean these are different regulatory bodies who governing, regulating different companies, different industries. Regulatory industry normally have to produce some form of accounting information for the regulators. In order to satisfy the relevant authorities, most organizations have to retain their accounting records and information for a minimum of 7 years. 7 years in case the authority wish to verify information at a future date. In UK, according to Companies House, you have to maintain accounting records in your business for 7 years. Legislation governing financial statements. Now we are moving towards how financial statements are prepared and who is regulating them. We need to prepare financial statements according to standards. And those standards are called IAS, International Accounting Standards, or IFRS, International Financial Reporting Standards. Along with these standards, we need to follow the local laws like Company Act as well. Because these standards are international. Along with these standards, we need to follow local laws, mean Company Act as well. So for companies, legislation covers do not only the need to prepare financial statements, but also how they should be prepared, including issues such as the frequency and format. This helps to ensure that interested parties are able to access the financial statements of a company as well as make sure that they have been prepared in an understandable way. The legislation varies between countries, but in the UK, it is known as Company Act 2006. Typical requirement for financial statement. Company Act in UK require the financial statements are produced that give true and fair view of the position and performance of the company. Position mean profit and loss account. Now position mean balance sheet, statement of financial position, and statement of comprehensive income. Our profit and loss account is called performance. The term true and fair is not defined in company law, but normally means the financial statements follow all appropriate accounting standards. Mean financial statements are true and fair. What does that mean? Financial statements are prepared as per accounting standards, contain information of sufficient quantity to satisfy the reasonable expectation of user, indicating that information is must be adequately detailed. Mean all the disclosures are provided in the financial statement. Mean financial statements including all the information for user, following generally accepted practices. Generally accepted practices mean standard that should be followed and should not contain any material misstatement, meaning big misstatement. The information should be reasonably accurate and should not contain errors that are large enough to alter their view of the company's affair. So what does mean by true and fair? Follow accounting standards, meet user need, follow generally accepted practices, and should not contain material misstatement, means shouldn't contain any error. Who is responsible for preparing financial statements? Board of director as a whole. All directors are equally responsible for preparing financial statement. But board of directors, they all are not having accounting knowledge. So they delegate their financial statement preparation authority to one member of the board, that is called a finance director or a chief financial officer, means CFO. But this alone is not responsible. Whole board is responsible for preparation of financial statements. But as they don't have a accounting knowledge, so they appoint or delegate their authority to one accounting expert. Who is accounting expert in directors? Finance director or CFO, chief financial officer. So under the company legislation, directors are responsible for producing financial statements that they give to and fair view. This is delegated within the company to the FD, finance director or chief financial officer. The financial reporting function within the accounting department will assist the finance director with this. Under finance director, there is accounting department, mean there are accountant. If the finance director does not have the skill to prepare the financial statements, an external accounting firm may be asked to provide assistance. Then they can outsource their financial statement preparation function to any external accounting firm. Consequences of compliance failure: if company do not comply with the laws, regulations, standards, what could happen? Failure to keep proper accounting records for 7 years, or to prepare regular financial statements that give a true and fair view, are both criminal offense. If they don't keep record for 7 years or don't prepare financial statements, give it true and fair view, there will be considered as criminal offense. Criminal offense means fines, penalties, even imprisonment will be there. In both cases, the responsibility is that of director, who can be fined for failure to comply. Should the company be listed, it may have its shares suspended by the stock exchange, meaning that they cannot be traded. In case company is not preparing true and fair financial statements or keeping records, there will be fines as well as shares will be suspended, mean you will not be able to sell, buy your shares on the stock exchange. There may be further problems with the tax authorities if records are found to be inaccurate. If the tax authorities launch an investigation and discover that too little tax has been paid, then the company may be guilty of tax evasion, which is illegal. They will also impose certain things. If poor accounting records mean that financial statements do not show a true and fair view, mean fraudulent financial statements directors have prepared, Sometimes they prepare to attract the investors. They show high profit and high asset, less liabilities, less expenses, so that they can attract investors. So the company's auditors may give a qualified audit report, and if financial statements are not true, auditor need to give qualified opinion. Means financial statements do not give that way. This can damage the company's reputation, and if company audit report is qualified, this can affect the repute of the company and make it harder and more expensive to raise finance because shareholder do not invest more money. Even existing try to withdraw their investment from the company because directors are producing fraudulent financial report statements, mean they are not producing true and fair financial statements. Finally, failure to keep adequate accounting records for 7 years could mean that the company has insufficient information relating to areas such as receivables and payables. It may fail to collect money owed from customers on time, leading to cash flow problems. Failure to pay supplier on time lead to lost goodwill repute as well as the removal of the company's trade credit facilities. Obviously, supplier will not provide you, will not deliver you goods on credit basis. International regulation on accounting profession. We need to follow international standard IAS, IFRS. Who prepare accounting standards we're gonna discuss now. There are four bodies involved in preparation of financial statements. One is called IFRS Foundation. One body under IFRS Foundation is working. His name is IASB, Accounting Standard Board. Another body working with IASB, IFRC, IFRSIC, Interpretation Committee. And other body is working, that is IFRS AC, Advisory Council. IC stands for IFRS, International Financial Reporting Standards, Interpretation Committee. AC stands for Advisory Council. All these three bodies are working under IFRS Foundation. So IFRS Foundation is the governing body, governing the process of accounting standards. Who issue the accounting standards? IASB, International Accounting Standard Board, they issue IAS or IFRS. What IFRS IC doing? They are just interpreting the standards, providing guidance how to comply the standard. So who issue the standard? Who define the standard? IASB, International Accounting Standard Board, who is working under IFRS Foundation governing body. And when IASB issue a standard, how to comply that standard? Who will provide interpretation? IFRS IC. IFRS AC Advisory Council providing guidance or advisory to IASB as well as a foundation regarding any issues in the industry. If industry is facing any accounting issue and there is no accounting standard for that issue, then this advisory council will provide information to the board, IASB as well as foundation. We need to define standard for this issue. Who will define the standard? IASB. Who will interpret that standard? IFRS IC. Can you understand this? So who issue the standard? IASB. How standard is issued? IASB issue an exposure draft first. What the issue?
Exposure draft.
Exposure draft mean raw form of standard that is not finalized yet. Mean they will write down certain rules of standard, and that certain rules that are not finalized yet will be called exposure draft for public comments. Mean they will send this exposure draft to different bodies, different institutes, different big firms in the industry. We are going to define this standard. If there is a need to anything change, add, delete, please provide your feedback. After public comments, that exposure draft will come back to the IASB. And what IASB will do, they will, after making necessary adjustment as per the comments, issue the final IAS or IFRS that is applicable on accountants. So who defined accounting standard? IASB, International Accounting Standard Board. How they issue? IASB first issue exposure draft for public comments. And after public comments, exposure draft will return back to IASB. And IASB, after necessary adjustment, will issue the accounting standard. Okay, let's discuss certain things. The role of IFRS Foundation. IFRS Foundation is a supervisory body, governing body for the IASB and is responsible for governance issues and ensuring each member body is properly funded. Mean AC, IC, IASB, they are properly funded and they are conducting their work properly. Who will govern? IFRS Foundation. Who is IFASB? International Accounting Standard Board is the independent standard setting body. They set or define standards of the IFRS Foundation. Its members are responsible for the development and publication of IFRS and interpretation. IC Interpretation Committee reviews widespread accounting issues in the on timely basis and provide authoritative guidance on these issues, mean how to comply standard in the industry. An advisory council is highlighting different issues and communicating to the IASB as well as foundation. So IFRS Advisory Council is the formal advisory body to the IASB and the IFRS Foundation. It is comprised of a wide range of members who are affected by IASB work, and their objective include advising the board on agenda decision and priorities in their work, informing the IASB of the reviews of the council with regard to major standard setting projects, and giving other advice to the IASB or to the trustees, mean against what issues we need to define accounting standards. So there are four bodies involved. Foundation, the main governing body, under which there are three bodies working: IASB, IFRS, IC, and AC. So IASB define the standard, set the standards. How? First, exposure draft for public comments, and then after making necessary adjustment as per the comments, issue standard. IFRS IC interpretation, providing interpretation guidance, and IFRS AC highlighting issues for the foundation as well as board. The role of IASB is to issue the accounting standard. IASB is an independent standard setting body which is based in London. It has 14 members from 9 countries. IASB aim is to develop a single set of high quality, understandable and enforceable global accounting standard and to cooperate with the national accounting standard setters to achieve convergence in accounting standards around the world. Standard produced by IASB The forerunner to the IASB are called International Accounting Standards. Standard produced by IASB are called International Financial Reporting Standard. Mean previously the name of IASB was IASC, and the previous old standards were IAS. Now the new standards defined by IASB are called IFRS. A new standard start life as a discussion paper. Mean there will be discussion paper in the public regarding any issue. The IASB assign a work group to develop a new standard, follow input from the SAC, and produce a first draft, which some points for discussion. This is then made available for public comments. The views expressed on the exposure draft, DP mean discussion paper, are taken into account in producing the next draft known as exposure draft, and public comments is invited. Finally, IFRS is issued and may later be amended if necessary. Mean before exposure draft, there is discussion paper that is issued from the public regarding any issue. And against that issue, IESB prepare exposure draft in raw standard and send to different bodies in the public, take their comments, and after necessary adjustment based on comments, they issue standard. There are some other regulatory bodies in the UK. Accounting standards in the UK are written by FRC, Financial Reporting Council. The FRC and its subsidiaries play a crucial role in oversight development of corporate governance. The FRC board is supported by three committees: the Code and Standard Committee, the Executive Committee, and the Conduct Committee. We don't need to read detail because we are going to attempt international rather than UK papers. This chapter is completed now. First MCQ. Find the correct option, please.
And the answer.
Option B.
Yeah, none.
The finance director is required by the Companies Act to prepare financial statements. No. Board of Director complete. The management accounting section is primarily involved in preparing the financial statements. No, they prepare management accounts like budgets. Financial accounting involved preparing financial statements. If a firm of accountants may be hired to help with accounts preparation at the end of the year, then they are responsible for them being true and fair. No, board of directors are responsible. Number two. The following are typical sanctions that can be imposed on a company. Qualification of the audit report by the external auditor. Sanction. Is that sanction?
No.
No.
Sus-
Suspension of trading of the company's share on stock exchange. Yes. Investigation by government officials.
It's
Tax authorities can investigate, not government officials. And fines by the government registration body.
yes.
Yes.
Option D.
Number three. Number three, try please. So the following are advantages of having legislation which governs the preparation of financial statement. Guarantee minimum level of disclosure of financial matters. Companies behave in a more ethical manner. Accounts prepared in different countries are more comparable. Accounts comply with accounting standards. Having legislation. Legislation means local government. Through legislation. Accounts comply with accounting standards. Not accounting standards. I think it's A. Guarantee minimum level of disclosure of financial statements. A. A. Through laws. Which of the following is not necessary in order for financial statements to give a true and fair view? They must follow general accepted practices. True and fair mean they must follow. They must follow all relevant accounting standards. They must be free from significant errors. Yes. They must be free from all frauds. Yes. D is not there. D was not there. Number 5. Try that, please. Board of directors as a whole? Yes. Number 6. That's enough for today. Enjoy today. Try to cover these 2 chapters. Yes. And there are some MCQs in kit regarding these 2 chapters, 10, 11 MCQs. You need to cover by yourself. We'll see you next class. New chapter, chapter 13. Try to prepare this subject during classes so that you can attempt this paper immediately after completing the classes. You will easily pass this paper. So that after that you can focus on other paper. It's boring, but we need to pass this paper. We are doing ACCA.
In skills level, you are working 50